Hello, everyone. Welcome to Talk Talk Speak podcast today. Can U.S. Treasury yields really give us a sneak peek into the stock market's next moves? It's a question that pops up a lot, right, when we think about that whole relationship between bonds and stocks.
It absolutely does. Yeah, I mean, lots of investors are trying to read the tea leaves, basically decipher those signals from the bond market. They're hoping, to get some kind of edge in figuring out what equities might do next. So today, we're going to do a deep dive into exactly that. We'll look at the sort of information you often see out there, articles, research papers, and really try to pull out the most important insights, give you a clearer picture without, getting totally lost in the weeds.
Exactly. Because getting a handle on this interaction, bonds and stocks, it feels more critical than ever. U.S. Treasuries, particularly that 10-year yield we always hear about, it's like the global benchmark for pricing assets. It influences everything, borrowing costs, how much risk investors are willing to take. And then you've got the U.S. stock market and the S&P 500, the NASDAQ that's our main gauge for economic health, for global risk sentiment. So how do they connect?
That's really the core of it today. So the plan is, first, let's break down the main ways bond yields can actually influence stock prices, the mechanisms, if you like. Then we'll maybe step back, look at some history, see how this relationship has actually shifted over time, depending on the economic backdrop. After that, we'll try to pinpoint the key drivers, what's really regulating this thing, the Fed's actions, inflation, that sort of stuff. And finally, we'll try to size up how good Treasury yields really are at predicting stock trends. Maybe even touch on what some folks are expecting for, say, 2025.
Okay, let's unpack this. Starting with those mechanisms. How exactly do bond yields push and pull on the stock market? What are the main channels?
Well, the most fundamental link, I'd say, is what we call the discount rate channel. When investors try to figure out what a stock is worth, they often models, right? Looking at the present value of a company's future earnings. Basically, how much is that profit down the road worth in today's dollars?
Right, the discounting part.
Exactly. And the rate they use to discount those future earnings back to today, that's key. Treasury yields often act as a kind of baseline for that rate, a proxy for the risk-free rate.
So, okay, if Treasury yields go up, that benchmark rate, that risk-free rate also goes up. And suddenly those future earnings, they don't look quite as valuable today. It's like the hurdle is higher for those future profits, making them less attractive now. Is that right?
That's a great way to put it, a higher hurdle rate.
And is that why growth stocks, tech companies on the NASDAQ maybe, the ones promising big profits way, way down the line, they feel it more?
Precisely, yeah. A higher discount rate just has a much bigger impact on the present value of cash flows that are further out in the future. Think about it. The further away the earnings, the more times that higher discount rate gets applied, compounding the reduction in today's value. And conversely, when yields fall, the discount rate drops. Makes those future earnings look better today, potentially giving stock valuations a nice boost. We actually saw that, didn't we? Late 2023, early 2024. Expectations of Fed cuts pushed yields down, and that definitely helped fuel the stock market rally.
Got it. So higher yields tend to pressure stock valuations downwards, especially for growth. Lower yields tend to help push them up. Okay, what's the next channel?
The second big one is asset allocation and capital flows. Investors are constantly juggling where to put their money, right? Across different asset classes. They're always comparing the potential return from bonds, it's the yield, versus the potential return from stocks, often looked at as, say, the earnings yield or dividend yield. Now, if Treasury yields climb to a point where bonds look, significantly more attractive on a risk-adjusted basis compared to stocks, well, investors might decide to shift capital out of the riskier stock market and into the relative safety of bonds.
The classic trade-off. Predictable, maybe lower returns from bonds versus potentially higher, but definitely more volatile returns from stocks. And if we look right now, I think the S&P 500's earnings yield is, around 3.8%, but the 10-year Treasury is yielding like 4.25% to 4.36%. So on the surface, that makes bonds look better, potentially pulling money out of stocks.
That's the simple snapshot, based just on those current numbers. But, and this is important, investors' decisions are driven by a whole lot more than just today's yield. They're thinking about future earnings growth, where inflation might go, their own tolerance for risk, even just the momentum in the market. So while that relative yield definitely matters, it's really just one piece of a much, much bigger puzzle.
That makes total sense. It's not just today's yield, it's where people think yields are going, what that implies about the economy. Which actually leads us right into the next mechanism, the economic signaling channel. How do yield changes kind of act like a forecast?
Right. Changes in yields, especially that 10-year, can reflect the market's collective guess about future growth and inflation. So, for instance, rising yields could signal that the market expects stronger economic growth ahead. And that's generally seen as a positive for stocks, right? Because stronger growth usually means higher company profits. We've even heard some analysts recently saying rising yields show confidence in the U.S. economy's strength.
Okay, so rising yields can be good news if it's about growth optimism, but there's another side to that coin, isn't there? What if it's about inflation?
Exactly. That's the tricky part. If the market starts worrying that inflation is going to stay high or even pick up speed, that also tends to push yields up. But in that scenario, it's usually bad news for stocks. Why? Because it ramps up expectations that the Fed will have to tighten policy, maybe raise rates more aggressively. That's pretty much what we saw play out in 2022, wasn't it? Inflation fears drove yields up, and both stocks and bonds took a big hit.
So the same move in yields going up, can mean very different things for stocks depending on the reason behind it. Growth optimism versus inflation fears. You really need that context.
Yeah.
Okay, in the last channel, how do yields affect companies' actual bottom lines, their earnings?
This brings us to the corporate finance and earnings channel. Treasury yields act as a benchmark for the interest rates companies pay when they borrow money, when they issue new corporate bonds. So when Treasury yields rise, companies' borrowing costs generally go up too. That means higher interest expenses, which can directly eat into their profits. This hits companies with a lot of debt particularly hard.
Right. Higher interest payments mean less money for other things, like investing in the business, R&D, expansion. So that clearly puts downward pressure on their stock price, especially if they're heavily leveraged.
Precisely. It affects current profits, sure, but it also makes funding future growth more expensive. That can dampen their stock valuation over the longer term. Companies with high leverage, lots of debt compared to equity, or those that really rely on borrowing for operations, they're especially vulnerable when rates rise alongside Treasury yields.
Okay, so those are the main theoretical links: discount rates, asset allocation, economic signals, corporate borrowing costs. But as anyone watching the markets knows, theory doesn't always play out neatly. You mentioned the usual inverse relationship, stocks up, bonds down, or vice versa, isn't always there. Let's maybe dig into some history now, see how this relationship has actually behaved in different times.
You're absolutely right. That common assumption, that simple negative correlation, it's definitely not a constant rule. It breaks down the bigger picture, the overall macroeconomic conditions at the time. That's what really dictates how stocks and bonds interact. So yeah, let's look at a few key periods.
How about we start with the late 90s, early 2000s, the whole dot-com bubble situation. What did the stock-bond dance look like then?
Well, leading up to the bubble bursting, we generally saw that negative correlation hold. Bond yields were actually trending up, which could have reflected maybe an economy starting to overheat a bit, or perhaps it was pulling some money away from that increasingly frothy stock market. Then, bang, the bubble pops. And what happens? Investors rushed into safe U.S. treasuries. Bond prices shot up, yields collapsed. Classic flight to safety, stocks tanked, negative correlation.
Okay, classic behavior there. Then came the 2008 global financial crisis, followed by that long period of QE, quantitative easing. That must have been different.
Hugely different. Yeah, post-2008, the global economy was on its knees. Central banks, especially the Fed, launched massive QE programs. They were buying up long-term bonds like crazy to push long-term rates down and flood the system with liquidity. And what did that do? Well, those super low rates and all that cash floating around, it boosted risk appetite. So both stock prices and bond prices generally rose together for quite a while. That meant we saw a positive correlation during much of that QE period. Unusual, historically speaking.
Interesting. So low rates and Fed buying meant both went up. Okay, skip forward a bit. What about 2017 to 2019? That was when the Fed started to gently tap the brakes, right? QT 1.0?
That's right. QT, quantitative tightening, the opposite of QE. The Fed was cautiously raising rates and starting to shrink its balance sheet, letting some bonds mature without reinvesting. During that time, the correlation was, well, weaker, sometimes negative, sometimes they seemed to just do their own thing, diverge. The economy was growing steadily, inflation wasn't really a problem, earnings were decent, so stocks kind of kept climbing even as the Fed was tightening, just moderately. The demand for bonds as a safe haven wasn't as strong then.
And then 2020, the pandemic, that must have just thrown everything haywire.
Oh, absolutely. Initially, it was textbook flight to safety again. Fear gripped the markets, everyone piled into treasuries, bond prices up, yields down. Stocks plummeted, clear negative correlation. But then, remember, March 2020, As the scale of the economic shock became terrifyingly clear, we saw this brief but really extreme positive correlation. It was the dash for cash, pure panic. Investors sold everything, even safe treasuries, just to get liquid. So for a short time, stocks and bonds both fell off a cliff together.
Wow. Just needing cash above all else. Okay, then 2022, inflation surges, the Fed slams on the brakes hard with rate hikes. That felt like another big shift.
It really was. Inflation was high and sticky, forcing the Fed into a super aggressive tightening cycle. Rapid rate hikes plus QT 2.0, a much faster balance sheet reduction than before. And this time, a strong positive correlation again, but the other way. Both stocks and bonds got hammered, falling sharply together. Higher rates crushed stock valuations via that discount rate channel, and rising yields mean falling prices for existing bonds. Simple as that. A terrible year for a typical 60-40 portfolio.
Right. And that brings us closer to today, say 2024, heading towards 2025. We've had ongoing worries, policy uncertainty, maybe tariffs. What's the recent dynamic been like?
It's been a bit weird, actually. We've seen more instances recently of that unusual positive correlation, both stocks and bonds falling together sometimes. And it seems like it might be driven less by the big macro story and more by technical factors within the market itself. Things like, say, big international investors selling off U.S. bonds, periods where it's just hard to trade treasuries easily, low liquidity, and also potentially hedge funds having to unwind these complex leveraged bets called basis trades. That can force selling and push yields up unexpectedly, even when you might expect flight to safety buying.
So market plumbing issues almost, causing weird short-term moves.
Kind of, yeah. Technical pressures can definitely overgrid the fundamentals sometimes.
So the big takeaway from looking back is that stock-bond relationship is definitely not fixed. It's not a simple seesaw. It really depends on what else is going on in the economy.
Exactly. You cannot just assume negative correlation is the default. The whole macro environment, inflation, growth, Fed policy, fiscal policy, market liquidity, even those technical factors, they all mix together to determine how stocks and bonds behave relative to each other. Understanding that dynamic context is absolutely key. We saw the theory, now we've seen how history messes with the theory.
Right. So let's focus on those puppet masters then. What are the absolute key driving factors that regulate this complex relationship? You mentioned a few.
Okay, yeah. Let's break them down. First, and maybe most obvious, is monetary policy. What the Federal Reserve does. Their decisions on the main interest rate, the federal funds rate, and their big balance sheet operations, QE and QT, they directly hit Treasury yields and really shape what the market expects to happen. That flows right through to stock valuations. Generally, yeah, tightening cycles, rising rates, shrinking the balance sheet tend to pressure stocks down. Easing cycles, cutting rates, expanding the balance sheet, QE, usually help support stocks. But and it's a big but, the pace matters and the context matters. Why are they tightening? Is the economy strong or weak? That changes the impact, as we saw comparing QT 1.0 and QT 2.0.
Absolutely. The context is everything. Okay. Monetary policy is huge. What's next on the list? Inflation.
Right. Without a doubt. Inflation is fundamental to bond yields. The current level, sure, but maybe even more crucial is where people expect inflation to go. High or rising inflation eats away at the value of future bond payments, right? So investors demand higher yields to compensate for that risk. And like we discussed, high inflation often forces the Fed to tighten, leading to that painful positive correlation where both bonds and stocks fall. It also matters a bit why inflation is high. Is it strong demand pulling prices up? Or is it supply chain problems causing shocks? Those can have different effects. Stagflation, slow growth, and high inflation, that's usually toxic for both.
Inflation, definitely a major player. Okay, what about just the overall health of the economy? Growth.
Economic growth prospects, yeah, they're central. They drive corporate earnings, which is obviously key for stocks. And they influence risk appetite, how willing are investors to buy stocks versus safer bonds. Now, strong growth is usually good for stock prices because profits go up, but strong growth might also spark inflation worries, pushing bond yields higher, so you could get that negative correlation, stocks up, bonds down. On the other hand, if the economy is slowing or people fear a recession, that usually hurts stocks. But in that scenario, investors often run to the safety of treasuries, pushing bond prices up and yields down. Again, negative correlation. And this is where that inverted yield curve comes in as a signal, right?
Right, you mentioned that earlier, where short-term yields go higher than long-term ones, the recession warning signal.
Exactly. It reflects the market betting that future economic weakness will force the Fed to cut rates later on. It's historically been a pretty decent, though not perfect, predictor of recessions looming.
Okay, Fed policy, inflation, growth.
Mm-hmm.
What else is pulling the strings? Government spending. Debt.
Yes, Fiscal policy, government spending, and taxes, and just the sheer supply and demand for bonds. If the government runs big deficits and has to issue tons of new Treasury bonds to cover the gap, that increases the supply. Basic economics says more supply can push prices down, meaning yields go up. Also, who's buying those bonds? Demand from foreign investors matters. And there's this concept called the term premium, basically, the extra yield investors want just for the risk of holding a bond for longer versus shorter. And if big concerns arise about, the long-term sustainability of government debt, that could potentially cause both stocks and bonds to fall if investors lose faith. Another positive correlation scenario.
Wow. Okay, so government borrowing matters. What about the market mechanics we touched on? Liquidity, how easy it is to trade?
Absolutely crucial, especially in the short term. Treasury market liquidity. If it suddenly becomes hard to buy or sell large amounts of treasuries without moving the price significantly, that lack of liquidity can cause weird, sharp spikes in yields that aren't really about fundamentals. And as we mentioned, the actions of big, leveraged players like hedge funds unwinding those basis trades can also cause these temporary, unusual correlations where technical factors dominate.
It's a good reminder that sometimes it's just the plumbing of the market acting up. Okay, last one. Those unpredictable things. Geopolitics, market mood.
Definitely. Geopolitical shocks, wars, major trade disputes, they ramp up uncertainty. That often triggers a flight to safety. Investors dump risky assets like stocks and buy safe treasuries. So stocks down, bond prices up, yields down, negative correlation. Trade policy shifts can do this too. And just the general market sentiment, the fear gauge, like the VIX index, that reflects overall investor anxiety and impacts both markets.
Okay, so it's this incredibly complex web. Monetary policy, inflation, growth, fiscal policy, market plumbing, geopolitics, sentiment, all interacting constantly. Now, you brought up the yield curve a couple of times. It's not just the level of the 10-year yield, but the shape of the whole curve tells a story. Right.
Exactly right. The yield curve, just graph plotting Treasury yields across different maturities from months out to 30 years, gives us deeper clues about market expectations. The most normal shape is upward sloping. Longer-term bonds have higher yields than short-term ones. That usually reflects expectations of decent future growth, maybe some inflation, potential future rate hikes, plus that term premium for locking money up longer. Then you can have a flat curve. Short and long-term yields are very similar. That often signals the market expects growth to slow down, or maybe we're near the end of a Fed tightening cycle.
And then the one that gets all the headlines, the inverted curve.
Yes, inverted. That's when short-term yields are actually higher than long-term yields. It's a big deal because, historically, it's been a pretty reliable warning sign of a coming recession. The thinking is the market expects the economy to weaken so much that the Fed will eventually have to slash short-term rates significantly. So investors lock in the current lower long-term rates now before they fall further. People often watch the spread between the 10-year and the 2-year yield, or the 10-year and the 3-month T-bill yield. When those go negative, that's inversion.
So inverted curve equals recession warning light flashing. But it doesn't perfectly predict what the stock market will do, does it?
That's a really important point. No, it's not a perfect market timing tool. While inversions have a good track record of preceding recessions, the timing is very uncertain. A recession might not hit for months or even a year or two after inversion. And crucially, the stock market often keeps rising after the curve inverts, sometimes for quite a while. It might only peak closer to when the recession actually begins. Plus, some argue that years of QE might have distorted the curve's traditional signals a bit. So it's a valuable warning, yes, but definitely not a signal to immediately sell all your stocks.
Makes sense. And does the shape of the curve affect different types of stocks differently, like growth versus value or large versus small?
It can, yes. A steepening curve, where long-term rates are rising faster than short-term rates, that can sometimes put more pressure on growth stocks. Remember the discount rate effect on those distant earnings. The impact on large cap versus small cap is maybe a bit more complex. It often depends more on the specific economic outlook and what kind of policies are expected. Sometimes small caps might be favored if certain policies are anticipated or during specific market rotations.
Okay, fascinating stuff on the yield curve signals. So let's bring it all back to the core question we started with. After looking at the mechanisms, the history, the drivers, the curve, can U.S. Treasury yields actually predict stock market trends reliably? What's the bottom line?
Well, if we look at the arguments for effectiveness, those theoretical links are real. Discount rates matter, asset allocation shifts happen, yields do signal something about the economy, and historically we saw examples where big yield moves did line up with big stock moves, especially around major policy shifts or inflation scares.
But The historical tour also showed it's messy. The correlation changes, sometimes wildly. So what are the big limitations? Why isn't it a simple crystal ball?
The biggest limitation is just that the relationship isn't stable. It changes dynamically, and there are just so many other factors hitting both markets at the same time. It's incredibly hard to isolate the pure effect of yields. Plus, cause and effect isn't always clear. Do yields move first, or are stocks and bonds reacting simultaneously to the same news? We also mentioned how market structures might be evolving. QE, QT, regulations, algorithmic trading may be changing those old relationships. And then there's just short-term noise, technical glitches, liquidity issues that can cause temporary disconnects from the fundamentals.
So putting it all together, Treasury yields are definitely a valuable indicator, giving us crucial information about the macro picture, about expectations. But leaning on them alone to predict where stocks are heading next seems like, well, an oversimplification. And potentially risky.
That's exactly it. They're a vital piece of the puzzle. They tell you a lot about the environment you're investing in, but they're not the whole puzzle. Relying on them in isolation for market timing, probably unwise. Now, maybe we can just quickly touch on where things stand now and what some are thinking about 2025.
Yeah, let's do that. What's the current vibe in the bond and stock markets? Where are yields now? How are stocks doing?
Well, recently, that 10-year Treasury yield has been bouncing around a bit, sort of in the, say, 4.2% to 4.6% range, so some volatility there. The stock market, it's generally been near recent highs, but also showing more choppiness, more volatility lately. And if you do that quick comparison, again, S&P 500 earnings yield versus a 10-year Treasury yield right now, on paper, the Treasury yield is actually a bit higher.
Okay, and what's the chatter among the big analysts, the banks, looking ahead into 2025? What are they seeing for bonds?
There seems to be a pretty broad feeling that current bond yields, especially on quality bonds like Treasuries, look relatively attractive after that big run-up in 2022. The general expectation, I think, is still that the Fed will likely continue easing policy, maybe cutting rates further in 2025, although huge uncertainty remains about exactly when and by how much. Forecasts for where the 10-year yield might end 2025 are all over the place. Some see it staying relatively high, others see it moving lower with Fed cuts. The big risks everyone's watching for bonds are definitely inflation, will it stay down, and government debt levels, that fiscal policy angle.
And what about the stock market outlook for 2025? Same analysts, what are they forecasting?
For stocks, the consensus seems to be continued earnings growth, but maybe slowing down a bit from the recent pace. That earnings growth is seen as the main support for stock prices. But lots of caution, too. Potential valuation headwinds, especially for some of the big tech winners, concerns about ongoing volatility. There's also a lot of talk about potential rotation volatility. Maybe value stocks or smaller companies could do better relative to the mega cap growth stocks that have dominated. And the risks are still there. Disappointing earnings, the Fed getting policy wrong, inflation proving sticky, or some geopolitical flare-up. Those are always on the radar.
So kind of a mixed bag, really. Continued growth expected, but maybe slower, with plenty of risks and uncertainties swirling around. As we navigate through 2025, then, what are the absolute critical things listeners should keep their eyes glued to?
Number one has to be inflation's path. Does it keep cooling, or does it surprise to the upside? That's paramount. Then, naturally, what the Fed does in response. Their policy decisions are key for both markets. Any major new government policies, fiscal spending, trade stuff that will matter too. And beyond that, just keep watching the flow of economic data, keep an eye on geopolitical hotspots, and maybe even pay attention to those bond market supply-demand dynamics and liquidity issues we talked about. They can all sway things.
Okay, so let's try to boil this all down. If listeners take away just a few core messages from our deep dive today, what should they be?
I think the main message is complex. The stock-bond relationship is complex, dynamic, and depends heavily on the broader economic context. Treasury yields offer really important insights, yes, but they are absolutely not a simple predictor of stock market direction. It's the whole macroeconomic environment, inflation, growth, policy that ultimately determines how these two massive markets interact.
And based on that, what are some practical takeaways? Things listeners can actually use in how they think about markets.
I'd say first, avoid relying on any single silver bullet indicator. Don't just watch the 10-year yield and think you know everything. Focus instead on understanding the bigger picture, the macro context. Accept that the stock-bond correlation changes. It's not fixed. Be aware of that. Pay attention to relative valuations, risk premiums. Think about whether you're being compensated for the risks you're taking. And maybe most importantly, maintain flexibility, stay diversified, and try to focus on your long-term goals rather than getting whipsawed by every short-term wiggle in yields or stocks.
Excellent advice. The complex relationship requires a nuanced view. Thank you for joining us. See you next time.